Welcome to Accounting with Professor Lamptey. Today we are going to explain the statement of owner's equity. If you are studying for an accounting test, preparing for an exam, or trying to understand financial statements for the first time, this is one statement you cannot ignore. Why? Because the income statement tells us whether the business made a profit or a loss. But the statement of owner's equity answers a different question. What happened to the owner's claim in the business? That may sound simple, but many students miss this point. They think if a business made net income, owner's equity must automatically increase. But that is not always the full story. A business can make net income and still have ending equity lower than expected. Why? Because owners may invest more money into the business. Owners may also take money out of the business. So the statement of owner's equity brings the full equity story together. It shows beginning equity, it adds owner investments, it adds net income or subtracts net loss, it subtracts withdrawals, and then it calculates ending equity. So today we will break this down in a simple way. We will explain what owner's equity means. We will explain why this statement comes after the income statement. We will explain beginning capital, owner investments, net income, net loss, withdrawals, and ending capital. Then we will build a full example and connect it to the balance sheet. Let's begin. Owner's equity represents the owner's claim in the business. In simple terms, it is what belongs to the owner after liabilities are subtracted from assets. You may remember the accounting equation. Assets equal liabilities plus owner's equity. That means owner's equity is part of the basic structure of accounting. If the business owns assets and owes liabilities, the difference belongs to the owner. So when we prepare the statement of owner's equity, we are explaining how that owner's claim changed during the period. Think of it this way. The income statement tells us performance. The statement of owner's equity tells us how that performance affected ownership. The statement of owner's equity reports changes in the owner's capital account for a specific period of time. That period could be 1 month, it could be 1 quarter, or it could be 1 year. Just like the income statement, this statement covers a period of time. That means the heading should say, for the month ended December 31st, 2026, or for the year ended December 31st, 2026. Do not write this statement as if it is only for one specific date. That is one of the first mistakes students make. The statement of owner's equity explains movement over time. Now let's look at the basic formula. Beginning capital plus owner investments plus net income minus withdrawals equals ending capital. That is the basic idea. If there is a net loss instead of net income, then we subtract the net loss. So the formula becomes beginning capital plus owner investments minus net loss minus withdrawals equals ending capital. Now let's explain each part. First, beginning capital. Beginning capital is the owner's capital balance at the start of the accounting period. If we are preparing a statement for the month of December, beginning capital is the owner's capital at the beginning of December. If we are preparing a statement for the year, beginning capital is the owner's capital at the beginning of the year. This amount usually comes from the ending capital balance of the previous period. So if last year ended with owner's capital of $30,000, then this year may begin with owner's capital of $30,000. That is why accounting is connected from one period to the next. The ending balance from one period becomes the beginning balance for the next period. Second, owner investments. Owner investments increase owner's equity. This happens when the owner puts more cash, equipment, or other assets into the business. For example, if the owner contributes $5,000 cash to the business, owner's equity increases. Why? Because the owner has added more resources to the business. Owner investments are not revenue. This is important. If the owner puts money into the business did not earn that money from customers. It came from the owner. So we do not record it as revenue. It increases owner's capital directly. Third, net income. Net income increases owner's equity. Why? Because net income means the business earned more revenue than it incurred in expenses. If the business made a profit, that profit increases the owner's claim in the business. But if the business has a net loss, the effect is the opposite. Net loss decreases owner's equity. Here is the important connection. Net income comes from the income statement. That is why the income statement is prepared before the statement of owner's equity. We cannot complete the statement of owner's equity until we know net income or net loss. So the first statement gives us the number we need for the second statement. Fourth, withdrawals. Withdrawals decrease owner's equity. A withdrawal occurs when the owner takes cash or other assets out of the business for personal use. For example, if the owner withdraws $2,000 cash from the business, owner's equity decreases. But here is a key point. Withdrawals are not expenses. Let me say that again. Withdrawals are not expenses. This is one of the most common mistakes students make. Expenses are costs incurred to earn revenue. Withdrawals are distributions to the owner. They reduce owner's equity directly. They do not reduce net income. Now, once we have beginning capital, owner investments, net income or net loss, and withdrawals, we can calculate ending capital. Ending capital is the owner's equity balance at the end of the period. This number is very important because it flows into the balance sheet. The balance sheet needs the ending owner's capital balance. That balance comes from the statement of owner's equity. Now, let's build a simple example. Assume Lamptey Consulting begins the month with owner's capital of $25,000. During the month, the owner invests an additional $5,000 cash into the business. From the income statement, we know the business earned net income of $4,300. During the same month, the owner withdrew $2,000 for personal use. Now let's prepare the statement of owner's equity. We begin with beginning capital, $25,000. Then we add owner investment, $5,000. Then we add net income of $4,300. Then we subtract withdrawals of $2,000. That gives us ending capital of $32,300. Now let's slow that down and think about what happened. The owner started with $25,000 in capital. The owner added $5,000. The business earned $4,300. The owner took out $2,000. So the owner's claim increased overall from $25,000 to $32,300. That is the story the statement tells. It is not just a calculation. It is a story about ownership. Now let's consider a net loss example. Suppose the business began with capital of $25,000. The owner invested $5,000. But instead of net income, the business had a net loss of $3,000. The owner also withdrew $2,000. Ending capital is $25,000. Notice what happened. The owner invested more money, but the net loss and withdrawals reduced equity. That is why we need this statement. Now, let's address some common mistakes. Mistake number 1, thinking withdrawals are expenses. They are not. Mistake number 2, thinking owner investments are revenue. They are not. Mistake number 3, forgetting that net income comes from the income statement. Mistake number 4, forgetting that ending capital flows to the balance sheet. Mistake number 5, using the wrong heading. The statement of owner's equity covers a period of time, so use for the month ended or for the year ended. Now let's summarize. The statement of owner's equity explains how the owner's claim in the business changed during the period. It begins with beginning capital. It adds owner investments. It adds net income or subtracts net loss. It subtracts withdrawals. And it ends with ending capital. Ending capital flows into the balance sheet. So when you look at the statement of owner's equity, do not see it as just another financial statement. See it as the bridge. It connects the income statement to the balance sheet. If this lesson helped you, subscribe to Accounting with Professor Lamptey, hit the like button, and leave a comment with the accounting topic that confuses you the most. In the next video, we will cover the balance sheet and show how assets, liabilities, and equity explain the financial position of the business. We are breaking down accounting concepts, simple, clear, and accurate. If this lesson helped you, subscribe to Accounting with Professor Lamptey, hit the like button, and leave a comment with the accounting topic that confuses you the most. In the next video, we will explain the balance sheet and show how assets, liabilities, and equity reveal the financial position of the business. We are breaking down accounting concepts, simple, clear, and accurate.